Hi, this is Matilda, and let's talk about SPACs. So what is a SPAC? A SPAC is essentially just a blank check company that's listed on a public stock exchange for the purpose of acquiring a private company. So basically, the whole intention of a SPAC is to list a private company without going through the whole traditional IPO process. So let's break down the players in a SPAC. There are three main players. You have your company, you have your investors, and then you have your sponsors. So your company is generally the target company that the sponsors want to acquire. So this company may or may not be known at the time of the creation of the SPAC. So this company is private and the sponsors are generally looking to bring it public. And then you have your investors. So your investors are like you and me. These are just people who want to have a share of the pie and want to invest in either the SPAC or the company that they are targeting to bring public. And then you have your sponsors. So your sponsors are going to be a group of individuals, or maybe it's just one individual, who are going to be your investment managers. And they're the ones who are going to look for their company to bring public. So when you create a SPAC, it's going to be your investment managers or your sponsors who are going to set up the SPAC, and they are going to give you either a description of the type of company that they're looking to bring public. So maybe it's going to be high-tech firms with large growth, or maybe companies that are specialized in the weed industry, or maybe they already have a specific company in mind. And they're basically just going to go out to investors and they're like, okay, we're going to raise a SPAC. This is the type of company that we are looking to acquire, or this is the type of company that we are looking to invest in. And are you interested? And if so, you can invest your money with us and we will go out and do all the heavy lifting, and we will do the due diligence, and we will look for a target company to acquire. And hopefully by the end of our 2-year life cycle for the SPAC, we will have acquired the company and you will get a portion of that company before it goes public. So if you're an investor in a SPAC, when the sponsors bring you a deal, generally you will have voting rights. So you can vote whether or not to approve of the company the sponsors are suggesting to acquire. And if you say yes, and the target company says yes, then the deal goes through. So what is the structure of a SPAC? So when SPACs are initiated, they usually come in the form of units first, and the units are part common shares and they're part warrants. So after the SPAC is traded for a while, they are usually split into either warrants or either common shares. So common shares are going to be your most commonly traded forms of SPACs, just because there are more opportunities for investors to trade them and they're less risky. So more brokerages like Robinhood will actually have these SPAC shares on their trading platform for you to invest in. So when the SPAC IPOs, the shares usually start around $10 a share. This will not be the case for all SPACs, but for the majority of them, that is what I've seen so far. So there are also warrants. So what are warrants? If you know what options are, warrants are very similar to that. Basically, they give you the option to buy a stock at a certain price after it reaches a certain strike price. So for SPACs, the strike price is usually at $11.50. So this is the price that you have the option of buying more shares at in the case that the stock price goes higher than this amount. So the only difference between options and warrants are that options are not issued by your company. Okay, options are traded between traders. Warrants, on the other hand, are issued by your company. So it's actually going to be new shares issued by the company if you choose to exercise this warrant. So this is one key consideration, because this may mean that warrants trade at a discount to shares, because although they are options to buy, when you exercise your warrant, ultimately you're going to be diluting your share in the company, because the company is going to have to issue new stock in order to fulfill that warrant. But again, all warrants are different and you really need to read the fine print for each warrant that you buy. Sometimes they can have additional restrictions, such as automatic redemption, or maybe a certain time frame which they can be exercised, and it's really up to the investor to do their own due diligence. And this is one reason why a lot of brokerages don't offer typical retail investors the chance to invest in warrants. In my view, warrants are essentially like gambling. In a SPAC, when you invest $10 in your common shares, if the SPAC doesn't go through within that 2-year time period, then the investors will receive that $10 back in cash. If you buy a warrant, on the other hand, and keep in mind this is just an option, so if the SPAC doesn't acquire a company in 2 years, then your option or your warrants are now worthless. So what are the pros of a SPAC? Why is it such a hot topic these days? Why do you hear it all over the news? And why are companies opting to go for it instead of something else? We can go through the pros for all 3 of our players in the SPAC. So let's talk about the pros for the company. So the main reason for a company to go through a SPAC to go public instead of something like a traditional IPO is that a SPAC will take a fraction of the time that it takes to do a traditional IPO. So when you do a traditional IPO, these investment bankers will have to do book building, they'll have to do all these roadshows, and this can take anywhere from like 2 to 3 years. Whereas a SPAC can really only take a few months, like maybe 3 or 4 months. This allows a private company to go public very quickly. And then for investors, so investors typically don't get a share of the pie when companies do traditional IPOs. These are marketed to institutional investors, and people like you and I were left out of the loop. So for us, this gives us a chance to invest in companies before they go public. It also is somewhat risk-free if you're investing in common shares because you get your $10 back. And for large investors, it's also good for them because they can invest in SPAC warrants, which allows them to buy additional shares of the company at a discount. And then lastly, for sponsors. So these are for the investment managers who are raising money through the SPACs. One of the biggest pros that I see is just that it's a cheap access to capital. So for a lot of these sponsors, the alternative route is to raise money through a VC fund. So this involves going to many institutional investors or rich people, and it takes a lot of time and effort. But by creating a shell company instead, the IPO process is a lot less stringent than for bigger firms, and there's less regulatory restrictions. And in addition, for sponsors, they also can receive 20% of the post-IPO SPAC shares. So for them, it doesn't really matter whether the stock goes up and down. They still make a profit either way. So let's talk about cons. For the company who is looking to go public, one of the major cons comes in the form of equity dilution. So this is 20% of the post-IPO shares that go to the SPAC sponsors, like what I was talking about earlier. For the investors, the cons are a lot more nuanced. When you're investing in a SPAC that has no acquisition target yet, what you're really investing in is the sponsor itself. So how reputable they are, how much you believe in that they can actually identify a profitable acquisition target and be able to take that target public within 2 years. On the other hand, the SPAC sponsors may be pressured by this 2-year deadline, so they're rushing to take companies public, and maybe they have a risk of identifying a not so great company and they just rush into the deal. Also, another thing to keep in mind is that SPACs are become very popular these days. And what that means is that because of the large number of SPACs, that means all these SPACs have to identify a good and profitable company to acquire. And that means the quantity of good acquisition targets are going to decrease over time. Also, we need to keep in mind one of the pros for companies. What I mentioned earlier was that one of the pros for a company to go through a SPAC was that it is able to go public quicker. Why would a company want to go public? Because this usually entails more regulatory oversight, and now they have to report to public shareholders, and overall it just looks like a really bad deal. One of the main reasons why companies go public is because they want access to capital. Okay, so if a company needs to raise money quicker than ever, this may not be a good sign in itself. However, it may not be a bad indication either. A lot of companies have opted to go with SPACs primarily because of the situation we're in right now. Due to COVID, the market has been really volatile, and companies typically like to time when they go public so that when they go public, their stock price pops on the first day. So instead of postponing an IPO, they can instead turn to SPACs and negotiate a proper offer price with the SPAC sponsors. So a lot of major SPACs have done well, like DraftKings, you guys might have heard of it. But from 2015 to 2020, returns from SPACs have actually performed worse than traditional IPOs. Okay, so now that you are aware of the pros and cons, if you want to buy, there are a few things that you should keep in mind. So SPAC shares usually IPO at $10. So there are a few things you want to keep an eye out for. So if the share price is substantially over $10 and they haven't even announced an acquisition target yet, you're pretty much betting on the sponsors of the SPAC to identify a good deal for you. So if the share price is over $10 and there has been a target company announced already, then chances are the price has already shot up a lot, and now what you're really risking is that the chance the deal doesn't go through. If the price isn't that much over $10, then 99% of the time they have not announced an acquisition target. And if they have, and it's still not that much over $10, then you should get out of it. But if they have not, then what you're betting on, again, is just the sponsors, right, to give you a good deal. But even still, this may be a good time to buy in because either way, the SPAC doesn't go through, you'll still get your $10 back. If you're looking to buy warrants, on the other hand, unlike shares, if the deal doesn't go through, these warrants will expire worthless and you'll lose all your money that you invest into it. So if you're watching this video, you're probably not the target market to buy a warrant, and I do not recommend it unless you want to lose all your money, or if you're just really into risky investments and you don't mind losing your money. So happy investing, and talk to you guys later. Bye!